every quarter, super investors release their updated portfolio with their buys and sells for that particular period. Now today our focus is on Warren Buffett, who has added Ulta Beauty as a new position, spending around $250 million. Now when we take a look at Ulta Beauty, we can see this company is trading right there at its 52-week low. Now with news of this being released after hours yesterday, we can in fact see it is up around 13%, now trading at 371. Still though, it will be towards the mid to lower end of that point. And we want to understand, should we also be looking to add this company into our own portfolio? And we're going to do a deep dive. We're going to firstly start off with understanding the metrics behind Ulta Beauty, and that leads us to the free cash flow per share. Now typically we want to see consistent increases over longer term, something we pretty much do get with this company. In fact, nearly 10 times growth over the last 10 years, and anticipated over the next 12 months to continue that growth. We also like the sales growth at double digit every single year, bar that COVID year, which is completely justifiable, where we had lockdown, consumers were unable to go to their favorite stores and buy the appropriate products. Even in the more recent year, 10% in 2024, we can still see that growth continue. And when you zoom out, looking at it from a numerical perspective, we can see nearly 4 times growth from 3 billion to 11 billion over the last 10 years. And one of the things we love about this company is the fact that they have a very minimal amount of shares outstanding and have been doing some nice share buybacks over the last few years, which is always a great sign for investors, ultimately returning excess cash to your pockets and giving you a larger portion of control of the company. ROIC, very important metric. We want to see 10% or more. Give us faith that management are able to effectively allocate their capital. Looking very strong, pretty much double digit every single year, bar that COVID year. 39% in 2024, 38% over the last 12 months, looking incredibly attractive for not just investors who currently hold a position, but also potential investors too. Now on the margin, 2 things we want to see. Firstly, a minimum of 16%, which is something we don't get from Ulta Beauty, pretty much straddles around the minimum level that we want to see. And the second thing that ideally we like to see from high quality companies, not just an increase to their top line, but also some operating efficiencies. Not something we see for the large part of the last 10 years, something though we would like them to do moving forwards. And free cash flow margin, at a minimum we want this at 5% or more, pretty much what we do see at least over the last 7 of the last 10 years, so that is a positive sign. And finally, the net debt to EBITDA, which is the earnings before the interest, tax, depreciation, amortization. This correlates to the balance sheet strength. Below 3 is what we want to see. That is what we get. It has also been decreasing. And remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. 0.49 in 2024, expected a small growth to 0.59 over the next 12 months, so the balance sheet does look to be very strong. Now, other parts of our analysis also include looking at insider and institutional movement. Starting off with insiders, well, 0.39%, 14 million worth of sales over the last year. And what we can in fact see, it isn't too common for insiders to be selling. It is every few months that we notice this. The more recent quarter of Q3, 39,000, so a fairly trivial amount. Quarter 2, around 253,000, and quarter 1, the largest sale, around 13 million. Now we will take a look to see who these insiders are, and in fact we have the director in the more recent period of 100 shares, and one of the largest, around 3,100, by an insider on the 19th of March. Now you could argue these are fairly outdated, plus the more recent one on the 2nd of July is a fairly small amount, but typically we do mention that insider selling, we see it as something that isn't a bearish signal, as insiders sell for many reasons, personal and financial. Now moving on to the institutional ownership, just above 90%, 2.94 billion worth of sales over the last year, with a little bit more buys, 3.54 to be exact, over the same period. And when we look at the more recent quarter, we do notice a marginal amount more of buys than sales. With the previous quarter, we see the complete reverse, a little bit more selling than buying. Now overall, yes, institutions are buying a little bit more and in the more recent quarter, but as always, do your own due diligence and never copy what these insiders do. Now we also want to let you know that we have released our latest free weekly article. If you want access to this or any other articles, all completely free, you can click on the pinned comment below to sign up. And we have also released our 35 undervalued stocks for consideration in August, where we also detail those that sit within our portfolios, so do go check that out by clicking below. Moving back then to the historical performance, as we can see, negative 28% over the last 12 months. Over the last 10 years though, you still would have outperformed the S&P up 238%, and we can in fact see a forward P sitting just below 13 at 12.81 with a double buy from Seeking Alpha and Wall Street, and we get that hold there from Quant. Now in terms of looking at their performance, well, we also like to look at their income statement and balance sheet. Taking a first quick look then at their revenues, as we mentioned, over the last 10 years, double digit every single year with nearly 4 times growth over the longer term. Then we can see that very clearly graphically. But the main thing we want to point out is what story can we see on the bottom line net income. 257 million in 2015, 1.29 billion in 2024. So again, some very strong growth, not just on the top line, but also the bottom line, and fairly consistent. Always a great thing to see with companies. Again, no surprises in that COVID year where both their revenue and their bottom line net income did fall. The other thing that we want to point out in their balance sheet is a quick health check where we look at the total cash versus their total debt. 539 million in 2015, 525 in that latest quarterly report. So when we look at it from a graphical perspective, very inconsistent and hasn't moved too much when we look at it just from a 10-year point of view. Now, the main reason why we do this in that number in isolation doesn't really tell us anything, which is why numerically and directionally we compare it to the total debt. And this has gone from around 0 in 2015 to around 1.9 billion. And when we look at it from a graphical basis, we can see over the last few years, it hasn't moved too much. And in fact, when we looked at the net debt to EBITDA shortly before, we saw that it did sit fairly low, in fact, well below 1. And therefore, overall, we can say the balance sheet does look to be secure. What we also like to do is look at previous performances against analyst targets as well as future projections. Very solid beats here, 4 out of 4, so a 100% track record over the last 4 quarters. Now they are anticipating a drop of 8% to the year-on-year EPS next quarter, but as we can see, the next 3 are looking positive. And if they do hit that EPS estimate of 28.19, the forward P will come down to around 11.7, something that you could argue does look to be very good in terms of that valuation. Now, speaking of valuation, we're going to take a look at some underlying metrics. The first one taking a look at the grading in specifics to the valuation. Now, they get a C+. When we look firstly against the P non-GAAP basis of 12.81, the sector does sit higher at 15, so ultimately if you have been adding Ulta around the 52-week lows, you would have been getting a discount of 14% in relation to the sector median, and we can see depending on which valuation metric you use, some of them they are trading at a little bit of a discount, however some of them they are also trading at a bit of a premium, hence why for this valuation part they do get that C+. We continue with the gradings, moving on to the growth where they actually get a D+. Now, you would be questioning why that is, given the revenue year-on-year growth sits at 8%, with the sector at 2%, as well as forward-looking 6.21 and the sector at 3.6. But the thing that drags this down is the earnings per share getting a D+, growth over the next 3 to 5 years, around 6.9% on an annual basis, whereas what we have here for the sector does sit a lot better at just under 11%. Then we move on to the final grading, which is the profitability. Now, it does sit at an A, which is good to note. Gross margin looking very healthy at 43% versus the sector 37%. And the bottom line does also look stronger, 11.1 versus sector 4.6. And finally, we also like to point out that their cash from operations does sit very, very large, 1.33 billion versus the 272 from the sector median. Now, just a quick conclusion for this part: a double buy Seeking Alpha from Wall Street, a hold from Quant, C+ on valuation, D+ on growth with an A on profitability. Now, before we get to our own valuation, let's have a quick comparison against others essentially in the retail sector. We have Dick's Sporting Goods, Chewy, Bath & Body Works, as well as a few well-known others. And we want to see if there are any other trends that we can spot as well. Over the last year, Ulta Beauty, one of the worst performing, negative 28%. But one thing we can take from here, other than DKS, every single other company in this sector has actually had a negative performance. So something to bear in mind, this whole sector has been struggling over the last 12 months. When we expanded over the last 5 years, we can see as well very poor performance, only up 2.5% for Ulta Beauty, and we can also see a few others that have had a similar poor performance, CHWY as well as 5. Now, when we expand this over the last 10 years, we can in fact see they are one of the better performing, up to 138%, and as we said at the beginning of the episode, outperforming the S&P during this time. Now, whether or not you believe these are really good metrics or really good performances, do remember that past performance is not an indicator of how this company will perform in the future. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $485, how we got to this? Well, we ran it through the DCF model where we have the free cash flow year on year, average growth for the last 10 years at 48%, and forward looking, we've gone for a very low 4% rate. Now, we have a low, medium, and high today at 4, 6, and 8, and we are going to use the low rate of 4 just to be extra conservative, especially if you do believe we are heading into a recession. With that discount rate of 8%, then we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get the $485 price, which ultimately gives us 33% upside. Now, if you believe that is way too conservative, well, at 6%, just for transparency, it will take the intrinsic value to $564, indicating 55% upside, and at the 8%, as we can see here, 656, 80%. As always though, these numbers are fairly subjective, so you can grab a copy by clicking on the pinned comment below and running through your own numbers, whether it is for Ulta Beauty or any others. So at the 4% level, we do take it to the final slide here where we get that intrinsic value that we just mentioned, but we always like to add a margin of safety on this episode, and at 10% is what we start off with and execute if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that, it is a buy up to $437, and then we keep going till it's near the current trading price. And in today's episode, we can see around that price, $1 shy, you are getting a 25% MOS, and that is after the pop that we see that Warren Buffett has now added this company into his portfolio. So 25% MOS with upside of 28% from Wall Street at $468 definitely means this is one that you should consider in the portfolio. Whether or not you want to buy though, do give us your thoughts below. As we saw, both Wall Street and Seeking Alpha do consider this a buy as well. As always, if you enjoyed the episode, value was provided, smash that like button, hit that subscribe and bell button. Don't forget as well to sign up to the free weekly newsletter below. And if you want to come and discuss our weekly buys and sells in the Patreon as well, we'll see you there. As always, have a great day and we'll see you all on the next one.